We begin tonight with the Indian markets. Is the bull run over? I ask because today Indian stocks took a dive. Everything was in the red. India's leading stock exchanges are the Nifty and the Sensex. Both saw a fall. The Nifty was down by about 300 points, more than 300 points. The Sensex dropped by almost 1,000 points. Leading names in the banking sector, telecom, oil and gas, even metal stocks fell. In one word, it was a bloodbath. And this is quite a contrast from the recent spikes. A few weeks ago, Indian stocks were being celebrated. Indian markets had become the fourth biggest in the world, overtaking Hong Kong. There was a clear upswing. Hence the question, has that momentum come to a grinding halt today? And the short answer is no. If you're investing for the long term, there is no need for you to worry. India's numbers are healthy. The government is looking at an 8% growth for the current financial year, that's 2023-24. The IMF is optimistic, that's the International Monetary Fund. They say India will, quote unquote, easily remain the world's fastest growing economy. So the growth trajectory is positive, but in the short term, the markets may see some turbulence. Which brings us back to the question, what caused today's slide, in fact? Most likely, market events like this one. Some big-ticket foreign investors have reduced their holdings in their Indian businesses. This includes the likes of Whirlpool Corporation. Now, Whirlpool, as you would know, is an electronics giant. It has sold a part of its India business. Same with Singapore Telecommunications Limited. It's a major telecom player, better known as Singtel. Since the year 2000, it has been a strategic investor in Airtel, one of the biggest telecom companies in India. Now, Singtel has sold some of its shares. 0.8% of its Airtel stock. That's what it has sold. In total, there have been at least 7 such instances in recent weeks, cases where a major player has divested a part of its India operations or is planning to do so. And why are they selling these shares? It's a strategic move. Market experts call it a strategic sale. You see, when the value of your business is at its peak, when your share price zooms up, you offload some shares and make money. That's a strategic sale. Businesses usually take this route when they're looking to raise quick money or when they want to cash in on the momentum. Both Whirlpool and Singtel need cash. Whirlpool wants to reduce its debt. Singtel wants more money to invest in data centers, so they went ahead with a strategic sale, and these businesses could not have timed it better. Since November last year, Indian markets have been on fire. Stock prices have shot through the roof. They're among the most expensive in the world now. For the last 8 years, Indian markets have gained continuously, so you could say this fall was coming for investors to make some money and to book profits. And that's what has happened today. But that's not the only reason for today's fall. India's small and mid-cap stocks saw a massive drop today. It was their worst day of trading in more than 2 years. Now, what are small and mid-cap stocks? These are small and medium-sized companies. Small and medium-sized by market value. They're listed on the stock exchanges. Small-cap companies are worth less than 5,000 crores. That's around $600 million. And mid-cap companies are worth between 5 and 20,000 crores. So that's around 600 million to $2.4 billion. And why do people invest in these stocks? For big returns. Because compared to large companies, small and medium-sized businesses can grow faster, potentially. They have room for exponential growth. So they can deliver substantial returns, which is why investors are eager to buy these stocks. They're looking for what is commonly called the next multi-bagger, a company or a group of companies that can deliver massive returns. At the same time, they can see a steep crash too. They can also fall substantially. It's the risk you take. Now, India's market regulator has been worried about this risk. It's called SEBI, the Securities and Exchange Board of India, SEBI, SEBI. SEBI thinks that there are signs of a bubble in these stocks. The SEBI chief gave a statement this week, and here is what she said, I'm quoting, "There are pockets of froth in the market. Some call it a bubble. It may not be appropriate to allow that bubble to keep building because when it bursts, it adversely impacts investors." Now, this statement came with some advice, and this advice was aimed at mutual funds in particular. The SEBI chief wants mutual funds to manage their risks better. their risk with small and mid-cap investments. The SEBI chief says this risk should be managed better, and the statement was almost like a directive, asking mutual funds to conduct what is called a stress test. They must do this stress test once every 15 days and disclose the results. Now, what is a stress test? It's like an internal assessment. It is designed to test whether a mutual fund in its current form can withstand sudden shocks. What kind of shocks? Like a large request from an investor for the withdrawal of their investment. If someone asks to pull out that money, can the mutual fund withstand that shock? They should be able to handle this pressure, and they should test this. Now, reports say mutual funds followed the SEBI orders, and that may have led to a churn in their portfolios. This is what has been happening. Now, if you put all of this together, if you connect all these dots, the big picture emerges. And it looks like this. No major cause of concern. Market fluctuations do not impact India's growth story. Plus, there's a large influx of investors in the Indian market. So there's a good reason for Indian regulators to step up vigilance, to introduce measures to shield the small investors from sudden shocks. That's what is happening.